If you receive the UK state pension, or will soon, this could affect how much tax you pay. Two pensioners receive exactly the same income every year, yet one pays no tax at all and the other pays over £1,500 in tax. And the reason it happens is something many people only discover after they retire. Hello, I'm Angie and welcome to UK Money Wisdom. Today we're going to look at something that surprises many people when they reach retirement. Two people can receive exactly the same amount of money each year, yet one of them pays no tax at all, while the other ends up paying hundreds, sometimes thousands of pounds in income tax. How can that be possible? Surely, if two people receive the same income, the tax system should treat them the same. But in the UK tax system, that is not how it works, because the tax system does not simply look at how much money you receive, it looks at what type of income it is. And that single difference, the type of income, can completely change the amount of tax that someone pays, you or I. Today, we're going to walk through a very simple example that explains this clearly. And once you understand it, you will see why many pensioners end up paying tax in retirement, even when their income does not appear particularly high. Let's begin with the simplest possible comparison. The two pensioners. Exactly the same income, but very different tax outcomes. Here you could see both pensioners receive £20,548 each year, yet one pays no tax and the other pays £1,596 in tax. Same income, different tax. And the explanation lies in where the money comes from. And you see, both pensioners are receiving the same total income of £20,548, but the sources of income are different, or the types of income are different. Pensioner A withdraws £8,000 from an ISA, while pensioner B receives £8,000 from a pension. And here's the crucial difference. Under UK tax rules, private pension income is taxable. ISA withdrawals are not taxable. ISA withdrawals, you see, are ignored by HMRC when calculating income tax. So, although both pensioners receive the same amount of money, HMRC sees something very different, as this table shows you. Here's what HMRC sees, and it counts £12,548 for pensioner A, but HMRC counts £20,548 for pensioner B. The difference produces £1,596 in tax. Now, moving on from this example, we all need to understand the personal allowance. Every UK taxpayer has a personal allowance. For the 2026-27 tax year, it remains £12,570. This is the amount of taxable income you can receive before income tax begins. If taxable income stays below that level, normally no tax is due. But once income rises above it, income tax begins to apply. To understand why more pensioners are now paying tax, let's compare the last tax year with the current one in this table. We see that in 2025-26, the state pension still left about £597 of unused allowance. But in 2026-27, the state pension rises again, while the personal allowance remains frozen at £12,570, as you see here. And that leaves only £22 of allowance remaining. Just £22. Just look at the gap comparison between the 2 years. This shrinking gap means almost any additional income now triggers tax. I think it's important that we look at what this means in practice. Many pensioners, you see, receive additional income from pensions or part-time work, as this table shows you. And because the state pension now almost fills the personal allowance, most additional income becomes taxable. And the additional income could be a small pension, part-time earnings, or 2 small pensions, not uncommon. Let's look at these 3 examples in more detail. Looking at the table above in example 1, the £4,000 small pension pushes income above the personal allowance. And the result is that the £4,000 pension produces about £796 in tax. Now, looking at this table above, in example 2, most of the £5,000 income becomes taxable. And the result of that is that £5,000 of earnings produces about £996 in tax. And finally, looking at example 3 above, many pensioners have 2 small pensions from previous jobs, and those pensions can produce around £1,396 of tax. Here's an important note about savings interest. It's important to know that pension income is treated differently from savings interest. Look at this table where certain income types are counted as taxable income and others are not, such as ISAs. You will notice that savings interest may or may not be taxable. And this is because of the personal savings allowance, as shown above. There is also the starting rate for savings to consider, which can allow up to £5,000 of savings interest to be tax-free if other income is low. That's the key point to remember. Pension income itself does not qualify for any of those allowances. Now you'll notice I've included a few planning tips above, which help to reduce tax, and people often consider these. The first one is building ISA savings. The second is timing pension withdrawals carefully. The third is using the 25% pension lump sum gradually. The fourth is considering flexible drawdown. The fifth is using the marriage allowance. The sixth is monitoring tax thresholds. And the seventh is using ISA allowances where possible. And I will be happy to produce a video detailing more about any of this information if you let me know in the comments. If you would like a deeper explanation of how tax codes affect pension income, you may find my video on HMRC tax codes helpful to you. A word of caution here. While it is sensible to understand how the tax system works, it is important not to take unnecessary risks. Avoid complex schemes promising unrealistic tax savings. Always be cautious of financial scams. Let me sum up again why this matters. As I have shown, two pensioners can receive exactly the same money or income, but the type of income or source of income determines how much tax they pay. So retirement planning is not just about how much money you have, it is also about where that money comes from. I'd be very interested to know how many people watching discovered this difference only after they retired. And if this example looks similar to your situation, feel free to share your experience in the comments below. And also please remember, this content is for general information only, and it's not personal financial advice. It's based on current UK tax and pension rules and public guidance for the 2026-27 tax year. But please remember, individual circumstances vary and rules can change. I do hope you found this useful, and if you want to be sure of receiving my future videos, please would you subscribe and like the video. If you know of a friend or loved one who could also use this information, then please do share with them. I'm Angie, and this is UK Money Wisdom. I'll be back with you again soon. Bye for now.